Greetings. This is intended to be the conclusion of several lessons we've spent together regarding the topic of capital gains and losses. Could we glance back for a moment and see what we've established before this lesson? In the first lesson we talked about selling assets and what we needed to know about them, about how the taxpayer would know the date they sold the property and the amount they sold it for. But we established a timeline by glancing back and establishing when the taxpayer bought the property and what the taxpayer paid for the property, what basis they had in the property. Then we did some brainstorming about the primary ways we could acquire property. You named some great ones in class, and we narrowed that long list down to about 3 that we were going to consider. We wanted to know the basis of property that we purchased, those that we received as a gift, and property we received by an inheritance. Then we went on to determine the basis of property that we received as a gift, considering rules that changed prior to 77 and after 76. We were concerned with appreciated property and even property that had depreciated in the donor's hands. We also touched on the basis of property that we received by inheritance and agreed that fair market value on the date of death would be the one that we would emphasize, even though the alternate valuation date could also be elected in real life. We used a handout and solved some of the illustrations in the handout to try to drive home the points and get us to understand and remember these concepts better. In this lesson today, we want to talk more about the tax rates for long-term capital gains. I'd like to talk about the historical, long ago, treatment of capital gains and losses, and then the more recent rates. In 2003 we had a rate reduction in the capital gain rate, and we would like to also obviously talk about the present tax rates that we have in our current tax structure. In this lesson we should also consider capital losses, the annual maximums that we are able to deduct against other income with capital losses, and what happens to any carryover, how long we can carry it over, and its impact on the future capital gains and losses to be reported by the taxpayer. There is a handout available to accompany this lesson. I hope that you'll take time now to go to the class website and acquire that handout, print it out, and use it to follow along. I think it will be easier for you if you followed along on the handout as we went through this material. Without going into too much detail, but touching on the subject, let me remind you that in the very first lesson we talked about the long-term capital gain deduction and how long-term capital gains were treated for a long period of time, from about 1954 to 1986. And then in the period from 86 to 97 we had something that was called the alternate tax rate, a maximum rate of 28%. We'd like to ultimately wind up with considering the reduced rates that we've had more recently with long-term capital gains, so that we could consider what the present treatment of those capital gains and losses are under current law. Recall that in the period of time between 86 and 97, there wasn't a great deal of benefit from the capital gains and loss provisions. The 28% maximum tax rate on capital gains didn't help all taxpayers. Yet all the provisions for identifying and grouping and netting capital gains and losses, most of which we've seen in other lessons, were left intact in the law. Many speculated that when Congress decided to reinstate the capital gain provision and the special treatment, that there would be all these rules in place and it would be easy for Congress to reinstate those. As a matter of fact, that's what happened in 97. Between the periods of time from 97 till May of 2003, we had these tax rates that I'd like to talk to you about now. Between 1997 and 2003, the maximum tax rate on capital gains was 20%. If you ask a typical person on the street what the capital gain rate was, that would be their response, 20%. That applied to most typical capital assets. There was another benefit that some taxpayers could benefit from. If their marginal tax rate was 15%, then their capital gain rate would be 10%. So that was distinctly different from the 28% we had experienced in the past that was for all taxpayers. Some didn't benefit at all. Now everybody would receive benefit from these new rates. There were a couple of other provisions that we need to consider as well. There was what we called a super capital gain rate, that being 18% maximum capital gain rate on property that you had held more than 5 years, and that was to go into effect with property that you acquired after 12/31 of 2000. Then this super rate of reducing the 10% rate down to 8% was also available for people in that marginal tax bracket. Again, the holding period had to be more than 5 years. Then there were two other provisions that were rather unique in these new rules. The maximum tax rate on collectibles, antiques, works of art, rugs, those kinds of things, was the same as the alternate tax rate had been, 28%. Not a great tax savings. And there was a difference for what we call unrecaptured Section 1250 property. That would be real estate that was depreciable, apartment houses, duplexes, those kinds of things. The maximum tax rate was 25%. So you can see that when Congress reinstated the provisions for capital gains, they didn't exactly simplify the process. There were many of these many questions that people had about the complexity of this new law that passed in '97. Now we come to current law. As I've said on many occasions, in May of 2003, Congress reduced the capital gains rates. I hope you've got the handout to follow along. It makes taking notes on this and remembering it a whole lot easier. Under current law, the maximum tax rate for capital gains is 15%. That's the one you ought to remember. That's the one that's currently in effect. For taxpayers whose marginal tax rate is 10% or 15%, the maximum tax rate on capital gains is 5%. So there's benefit for capital gains for every taxpayer, regardless of their level of income, regardless of their income tax bracket. With this reduction across the board for capital gains rates and having everybody benefited, two of the provisions that were in place between '97 and '03 were no longer necessary. The 18% and 8% super capital gains rates were repealed in '03 because there would be no benefit. Those rates were higher than the regular rates would be under current law. Then we had to consider the other two exceptions that we had. The 28% and the 25% rates for collectibles and unrecaptured Section 1250 gains were untouched. Those two provisions remained intact in the law change in 2003. So let's apply what you've just been exposed to. Turning your book to problem 543. Why don't you stop the tape while you find your book and read the problem to yourself. And when you've read the problem, come back, restart the tape, and make your decision about these three items that are described in that problem. I trust you're back and have read the problem. Let's consider case A. What would the tax rate be on a $10,000 gain from the sale of common stock which had been held for 7 months? Now remember, your choices are 28%, 25%, 15%, or 5%. Or maybe some other answer. You choose. I really do hope you've made one of the selections. The right answer is 33%, the regular marginal tax bracket for the taxpayer, because the stock had only been held for 7 months. Let's consider case B. At what rate would a $10,000 gain from the sale of an antique clock held for 6 years be taxed? Make up your mind and choose, please. Since the antique clock is considered a collectible, it would be taxed at 28%, lower than their marginal tax rate, but not as good a benefit as the other lower tax rates because it's a collectible. Let's consider case C. The $10,000 gain from the sale of preferred stock held for 3 years would be taxed at what rate? Please make up your mind and choose before you go on to the next slide. Because the stock is a capital asset, because it had been held longer than a year, and because of their marginal tax rate, this stock would be taxed at the highest capital gain rate of 15% for these taxpayers. That's a distinct advantage for these taxpayers too. Remember that prior to 2003, the maximum tax rate was 20%. Now let's expand our horizons a bit. We need to consider the deductibility of capital losses, including the maximum per year and any resulting carryover and how that carryover would be treated in the future. Let's use problem 549 as a good illustration. How about stopping the video, turning in your book to 549 and read it to yourself, and when you've concluded reading it, restart the video, and oh, by the way, you could benefit from the handout. If you don't already have it, print it out. Now would be a great time to use it. I hope you'll compare the facts in the book with those in the handout and those you see on the screen here, and make sure that we're working from the same information. Now, perhaps you recall that there are some steps that we need to go through. We need to combine the short-term gains and losses. When you net those two, 4,000 gain minus 9,000 loss, you get a $5,000 short-term capital loss. We also need to combine the two long-term items. A $6,000 gain with a $5,000 loss comes out to be a $1,000 gain. Now we must decide on the interaction between the short-term loss and the long-term gain. In a previous lesson, you were to learn that when their signs were alike, they kept their individual characteristics and were not netted. But when their signs are different, as they are in this case, they are netted. These two netted together come out to be a $4,000 loss, a short-term loss. Perhaps you know the maximum deduction for capital losses is $3,000. The problem asks us to find AGI after considering these capital transactions. We're going to start with the AGI 40,000, reduce that by the $3,000 in capital losses, the annual maximum, to get a net result of AGI after considering these transactions of $37,000. Now we must consider the amount and the proper treatment of any loss carryover. If there was a $4,000 short-term loss and $3,000 was deducted this year, then $1,000 was unused and carried over to the future. We would group that with the transactions of the following year among those that are alike. If it's long-term, it goes with long-term. But in this case, it was short-term, so it would be grouped with the other short-term items. In 2011, the facts given in the problem and on the handout and on the screen would indicate that the three short-term items would need to be netted. 5,000 in gains, 3,000 losses, and 1,000 loss nets out to a $1,000 gain. By the same token, the long-term items would need to be grouped. The $10,000 gain minus the $21,000 loss nets out to an $11,000 loss. If their signs are alike, then they're not netted. These signs are different. The excess of the $11,000 loss over the $1,000 short-term gain is a net long-term capital loss of $10,000. 3,000 of that loss can be deducted in the current year, the annual maximum. The $50,000 AGI would then be reduced by the $3,000 capital loss for AGI of $47,000. Let us consider the amount and character of the loss carryover. It was a $10,000 long-term loss, $3,000 of which we used this year, making it a $7,000 carryover. Carryovers retain their classification. Short-term remain short-term, long-term remain long-term. So this long-term would be grouped with the transactions in the following year that are long-term in nature. In 2012, the two items need to be netted. $7,000 minus $5,000 nets to a $2,000 gain. The three long-term items would need to be netted. $2,200 minus $1,000 minus $7,000 nets to a $5,800 long-term capital loss. Since the short-term and long-term items have different signs, one a gain, one a loss, they need to be netted. $2,000 minus $5,800 is a $3,800 loss this year, $3,000 of which could be deducted this year. Before considering these capital gain and loss transactions, AGI was $60,000. Reduce that by the annual maximum of $3,000 in capital losses to see that AGI is $57,000 after the capital losses. Now we must determine the amount and character of the carryover. Since the $3,800 loss was long-term and $3,000 was deducted this year, that leaves an $800 long-term loss to carry over to the following year. And as we have seen on other occasions, losses keep their nature. Short-term remains short-term. In this case, long-term, when carried to the following year, is grouped with other long-term transactions. And again, we're ready to net the transactions. A $10,000 short-term gain reduced by a $12,000 short-term loss would net to a $2,000 short-term loss. The three long-term items are to be grouped: a $6,000 gain minus a $9,500 loss and an $800 loss, net out to a $4,300 long-term capital loss. This time the two loss positions have the same sign. The $3,000 annual maximum comes from the short-term first. $2,000 of the short-term loss is used, and then $1,000 of the $4,300 long-term is used to come up with a total of $3,000 in capital loss deductions, the annual maximum. To determine AGI, we would begin with the $70,000 in AGI before the capital transactions, reduce that by the annual maximum of $3,000 in loss. AGI would then be $67,000 in this circumstance. Let's determine the amount and character of the loss carryover to the following year. We used all of the $2,000 short-term capital loss and $1,000 of the $4,300 in long-term capital losses. That leaves $3,300 in long-term losses to carry over to the following year. Carryovers keep their nature. Short-term is short-term and long-term is long-term. We don't know the amount of the transactions for the following year, but we do know that the $3,300 loss will be grouped with other long-term transactions. I hope this has been a beneficial lesson for you. I hope you've done some thinking as we discuss these various groupings and consequences, and I hope that you've understood it and can communicate it to others. Have a great day.